Well, we made it to 15 in a row. From what I've seen, this is the longest streak of of consecutive Mondays in a row. 15 straight Mondays we've rallied. This one actually got above 1%, so it actually was a pretty significant move, a pretty decent gap to the upside. So we're going to talk about some of the good signs that we're seeing here that would suggest that we are bouncing up, and then of course kind of what I expect to see. Whether or not this is a going to be a failed rally, or whether there's a good chance that we actually extend and break out here and really get going to the upside again on that precipice of whether or not we're in pullback mode or correction mode. Small cap index obviously full on correction mode. The S&P has been on the brink of correction, but still kind of in pullback, which has, as we've talked about many times before, some significant implications depending upon which one it is, as to how fast we rally back up towards the previous high of 4,600 or the ultimate high of 4,800 that we hit pre-correction in early 2022. So we're going to break down the rally here and take a look at just how significant it's been. And from a breadth standpoint, again, positive breadth today. How good was it? We'll look at that. What was the big driver for today's move? And then we'll take a look at a bullish trade today, a stock that's been in a bullish trend itself and has been bouncing back up and setting up for a good bullish position. And we'll talk about how to trade that. So let's go ahead and get started. Today is Monday, October 16th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video that I do at 3:30 Eastern time. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click the thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. That's why we always ask for it. So thank you. Those of you who click on this day in and day out, and those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see the intermediate line is continuing to rise, now out of bearish territory. Still in the lower half of the chart, but out. So that's why you got the light green shading. The near-term line, which had broken below the intermediate line on Friday, a little bit into bearish territory, has come back out of it today. Momentum line jumping up. That's a good sign, right? That's very good short-term sentiment. There is a bear tag, and we're only 0.15%, so really important that we follow through on this, not with like these kind of small days, but with some of these bigger up days that you see here. Right? We really need to push higher on these bear tags and really push. You can see all of these, just really strong moves. You get these kind of weaker moves, and we don't go anywhere. So that's kind of the idea. You can see these bull tags and bear tags can be reversed, can be continuation patterns, right? We just continue that bullish trend. In this case, continue the bearish trend, unless you can really follow through on the reversal. So really important day for the S&P tomorrow in that regard. The NASDAQ, remember, it's actually doing a lot better. Thank you to those 7 companies that make up nearly 50%. Give me 1 second. Let's see here. Let's bring up the NASDAQ 100. There we go. Finally got the keyboard working. So it already got its bear tag, right? And we didn't really follow through on it. And that's kind of what I'm talking about is, makes it more susceptible to failure. Its near-term line, unlike the S&P, the near-term line has not bounced back above the intermediate line. So keep that in mind. The momentum line also did not get up nearly as strongly to the upside. The Dow Jones Industrial Average, the near-term line, momentum line did bounce back up. You're still a smidgen away from a bear tag on the Dow. The last bear tag really failed hard. So we're just a smidgen away from that. We're still at 0.05% below the moving average. The intermediate line at least has crossed above the market sentiment line. And then finally the weakest index, the Russell 2000, the intermediate and the market sentiment have both actually fallen into the lower reversal zone coming off of Friday's cluster. And then the short-term sentiment bounced up, but didn't bounce up very much. We're still more than 2.5% below the moving average, so not a big move up there. So you're nowhere near a bear tag on the Russell. So remember, the Russell's the one that's really got hit the hardest out of all the indexes. A lot more than what we've seen on the Nasdaq 100, especially. I mean, the Nasdaq 100 after we peaked on July 31st, right when the S&P peaked in July 31st, like the Nasdaq's barely down at all, whereas the Russell's like way down here. So big difference between those two indexes. Hence why that ratio has gone up so much that we always look at. Let's take a look at the weekly chart here for the S&P. So the nice start to the week has started us off with a bullish candle. So that's a good sign. Higher close. We haven't quite closed above this body yet, but again, we're only one day into it. And we do have the green arrow, which means we actually did close above the 10-week. The Hakinyashi didn't. Candle didn't, but the regular candle has closed above the 10-week exponential, so that's a good sign. The PPO is still falling, so we're not out of the woods here, but again, you got to start with something, and this is a good start for the S&P. The Russell 2000, as you can see, is actually still bearish, and as of right now, it actually still is a lower close on the Hakinyashi basis, despite what would be a second straight higher low point. So that's not as strong of a move. Of course, your Nasdaq is a lot more bullish. It obviously has the green arrow. Got that last week, and then now we're moving up higher. Still has the falling PPO. Looking at the three green arrow charts, of course, the S&P has three green arrows now. The Q has a renewed three green arrows. So you've had what? 4 out of the last 5 days, you've had three green arrows on the Nasdaq 100. You do have two greens on the Russell, and you have two greens in the Dow, and you're close to a third. So now it's a matter of, okay, is this going to be more than just a one-day deal, like you can see, which can be the reversal, or are we going to start a multi-day move where we get this bear tag and we follow through? That's the important sign, that we can't just come right back down below that moving average and have it be just a one-day deal. That's the last thing we need to see right now. Looking at some of the other oscillators like the DMI, again, this isn't really showing very. I mean, the positive is actually still not only below the negative indicators, actually still below 20. So we're not really getting a strong move there, and you still actually got the breakout pattern on the Russell. So again, it kind of goes to show like you need more than just one day, as much as we like to kind of crown the one day as like, hey, we're done. In fact, it's been more than one day. We've had 1, 2, 3, 4, 5, 5 out of 7 days to the upside here. We are back up above 50 on the R side, though not above 60. We're above 100, but not really above that 150 mark. And of course, the weekly CCI is still not even above 0 yet. So we're still a long way from reversing, and of course the Russell is nowhere near it, right? The Russell is still below minus 100 and still way down here on the weekly basis, and on the daily chart you can see still in negative territory. So one day, as you can see, doesn't make a difference here. The Ichimoku cloud, I talked to you already about, the one positive sign we got last week was the idea that we got to 0 on the trend quality and trend noise balance. That is a good development. We haven't started off in any other direction yet. That's not the case for the Russell. Still in very mature, bullish trends. And then looking at the Qs, you can see we also are, down to really low near zero levels. So no trend going at all. The Russell 2000 or the Nasdaq's actually close to a crossover here on its cloud. It actually did cross over barely over here, but it's close to that crossover. Of course, IWM is not. SPY is not as close, but that would be a good sign, right? That's another sign that we've actually turned bullish. Get above this blue line, get a positive rate of change. So we're not quite there yet. We're still around the middle. We haven't gotten up into that upper quartile. We got, again, one positive development for a trend change is that we got the red dots, and you can change your momentum to, when you go through that red dot gate, so to speak. So that is one development. We have to get up into the upper quartile so we don't change our momentum down here in the lower half. You have to, even this kind of failed change of momentum, which didn't last very long, it got at least briefly above into the upper quartile. So we're still right around the midpoint, and again, the Russell 2000 is easily in the lower half of the chart, not even close to the middle of the chart, and the bands, also moved inside the Keltner channel. So again, a red dot there, and a sign that we might change directions on this momentum. You also have, as we mentioned before, the high point, is a couple more days away from dropping all the way down to here at the very least. So I mean, we are set up for a breakout, for a positive breakout, a move up to 100 on the green line, which would mean a new 4-week high point. It won't be necessarily because we're breaking through to the upside, though that would be very welcome sight. It would most likely be because the high point after a couple of days has dropped down to this high, right? To these two that we talked about before. And as we talked about before, Mondays are important days, not just because we've had 15 in a row to the upside, but because they either set the high point for the week or the low point for the week. Last week it set the low point for the week. Previous weeks it was setting the high. So is this the high of the week, especially considering that we have a gap there that we didn't fill? Did we set the high for the week, or are we? Is this the low? Right? Is this going to be the low? And this was like a runaway gap. It wasn't quite meeting the description of a runaway gap. Like we were kind of a significant gap, but not quite 1 standard deviation, and we only barely finished above 1%. You'd like to finish up closer to 2, and so not quite a runaway. But about as close as we're getting right now. So really important to see that we break through last week's high point tomorrow or Wednesday. I don't think it will. I expect it will fill in the gap, and this will probably be the high of the week. And we'll probably test the lows before we test the highs, especially over the next few days. We'll probably end up, by the time the high point drops to here, we'll probably be down in this area of the chart. And the midpoint's going to really drop down, probably down to last week's low is where the midpoint's going to be. For the new 4-week range. And that 4-week range is, it's not very strong. Like, it's already kind of dropped down. It's going to drop down even more once the high point changes. So, we're setting up for a significant move, either a breakout to the upside, which is what you'd expect with the red line dropping below 70 and the green line already hitting 0, or a failed breakout like we had over here and we just were in new leg lower. Which is, again, the direction that I'm expecting there. Obviously, we haven't, let's go to the range today. We haven't had a big blowout move yet. We haven't had a big range. Today's range was actually below average. The volume is really low. Again, not the type of move you'd like to see when you get the bear tags. You like to have some bigger moves, right, to really change the sentiment when you're changing through an important area, and that obviously was not the case. Looking at the volatility today, the VIX really did come down, like as it does typically on Mondays, because Mondays, you didn't tend to be bullish days, 15 in a row. The VVIX came down hard. We had jumped up to the highest level since the banking crisis. We are already back below 100. So it doesn't stay below 100 or stay above 100 for very long. And it wasn't the case here. It didn't stay above 20 for very long. Didn't even finish above 20. Still hasn't finished above 20. And we're already back below 18. We're already back into the neutral zone here for the VIX relative to the VIX 3M. And for that matter, when you look at it compared to some of its average values, it's already back below its 200-day average value. So that was a big move to the downside. There's a brief move to the upside on Friday, and we've already corrected it today. And we'll see if that continues or not, whether we stay above. Remember the longer term lines, you can see the 8 and 17 average values, 8 and 17 day exponential average values have already crossed above the 30. And that typically starts to change the regime that we're in here. So keep that in mind that, things might be getting a lot more bullish for volatility. The last few weeks we've had some moves to the downside, but unable to stay. And you wonder, so with such a big move to the downside today, whether this week we'll be able to follow through on that, or whether we'll just correct it and like we did last week and move back up. Which, again, considering the potential regime change there, that's kind of what I expect will end up happening. On Friday, we had a kind of a rare move where gold moved up so much, the dollar moved up a ton. and so did the volatility index. Big moves higher. Not surprising because you had some uncertainty going into the weekend, especially from a geopolitical standpoint. So hence why those three. But I mean, it's not very common, and typically you get as big of a moves that they got all together. You typically get those kind of moves and during kind of washout phases or around washout phases of bear markets. So kind of rare to see it when we're not in a bear market, when we're actually not technically in a correction yet either. That goes to show, again, kind of the skittishness around what's going on in the Middle East. Today, the big mover today was yields being to the upside, but it did not have a negative impact on stock prices, which is interesting because that's not a common reaction to the equity market from bond yields. So bond yields, if I were to pull up that chart here, let's pull up this chart. If you look at bond yields, they made another run back up to above 4.7%. The intermediate, we're still bullish here. We're just bouncing up off a higher low. If you look at TLT, which is actually the 20 to 30 year bond, you can see that it's still dark pink shading and a red line, so still heavily bearish. But that still didn't sway equities. So that's that correlation now between equities and the stock market starting to take a not jumping up as high, starting to pull back a little bit more as that they didn't move together in the same direction today. Very, very significant opposite move. So that was kind of the interesting pattern to today. Of course, the dollar was down, and that probably had the biggest impact on the on bullish risk appetite. With the dollar being weak, and for that matter, commodities also giving back some of their gains, going into just a little bit of their gains going into the weekend. But the dollar was kind of your bigger mover. You can see pulling back just to the 8-day, and you're weakening, you're diverging. The MACD is actually below, and again, I don't know why. This drives me crazy on this particular chart, but I don't know why it shows these ranks so strong. But you can see the MACD is below its moving average, even though you're still kind of above the 17-day moving average. So you're still in convergence mode, but that's been enough of a convergence to bring the stochastics into the lower half of the chart. And so you're actually kind of technically set up for a bounce move back up, kind of like what we had here, even though your stochastics didn't drop nearly as far this go around. Where we just came to the 17. I mean, we did come below the 17 briefly, but last week at the end of middle of the week, Wednesday, we really jumped up and pretty much have stayed above that average this time. So you're still kind of showing some broad weakness, not just here in the U.S., but across other major areas, including in Europe. You got some strength in India still. You got a rising trend. You're about to get dark green shading in a green line. That's about really the only pocket of strength among these bigger economies. UK is not doing as bad as its market. It's probably got the highest intermediate line out of all these bigger economies there at 62. And of course, the U.S. markets, along with Brazil, is really one of the only ones that's got that bear tag. Everything else is still kind of struggling with red lines, right? We're not able to get above those moving averages yet. And you can see that too from a breadth standpoint showing up in the sector rotation. If you look at the breadth, there's a lot of chatter about the breadth today, but the McClellan oscillator only got to 21 on a ratio adjusted basis. That's not very strong. When you look at the new highs and new lows index, you can see here that didn't move up very strongly either. We're above the moving average, but we're still pretty easily negative here. So that's not, this isn't the biggest breadth move to the upside. One positive development is the number of stocks above the 50-day moving average did jump back above 150. Wasn't the biggest move higher, but we're still above its moving average, and you're still above 150. So that is a positive development there. It looks like it's trying to figure out a basing pattern here. You can see if I were to go out and look to some of these other corrections that we've had, when it does get below its moving average, you can see on some of these rallies, it can get above the moving average and only to fail and move back lower. And it appears that because we're not really like breaking up to the upside with a strong move, so it appears that that's kind of the case as of right now. We haven't had that big breakout back above some of these old lows right around 150, and breaking back above that, I guess, would be more like 160, to the upside. So really important that we don't just kind of stay up here for a few days, again, like we saw over here last June, and then come right back down to this falling average, which is actually, the third lowest level of the past 2 years. Only those June lows and October lows, you have even worse breadth than you have now, even though those were significantly bearish low points, and this one obviously just is not. But the ratio chart here, which is kind of another sign of breadth, did come down. It didn't finish at the lows of the day, but at least it did come down. Didn't finish below the 8-day either. Again, some more weakness in this particular ratio isn't necessarily the most bullish thing for the markets. It's right now it is, because the negative correlation, but it's not common for this to be a negative correlation. It's more common for it to be positive. So at some point in time, that correlation will return back to what it normally is, and in which case you don't want this ratio to drop, right? That's not how. And I told you before, when we had that breakout last week to the upside, that usually at best that means your ratio is go sideways from that point on or down. And previously, all these other moves, you had very strong or at least somewhat positive correlation. This is very negative correlation by the time you had that breakout pattern. So it's probably not the best breadth setup right now going forward. Kind of a good breadth day today, but not nearly as good as what a lot of people suggested that I heard about discussing the market action today. Let's take a look at how the sectors moved. So let's come over here to this chart and take a look at the sector comparison chart for today alone. Let's drop down to October, the 16th there. Big moves in discretionary and communication services. Big moves. Not so big move in technology though, and that's kind of interesting to see. At first, those three kind of went okay, but technology started to weaken throughout the day as the market was unable to build on its early gains, and these two kept doing their own thing. So, I mean, that's a good sign to have those two sectors doing well. It's not as good a sign to have. I mean, technology has, the two biggest companies out there, and three of the four when you include Nvidia, how far it's moved up from a weighting standpoint in the S&P. Google being the one that's bigger, the third biggest company. So that's an important sector, and not necessarily what you want to see underperforming the market. And only seeing like these two are very skewed to just literally two stocks in each of them. And so we don't necessarily want to see just those two performing so well without technology also doing well. And if you look at the 12 grid here, and again, so that's not the biggest breadth either when you have those two stocks doing well. Again, XLC doing very well. Technology has got a rising intermediate line, though it's still got moving average that's falling. And of course, discretionary is the worst. And on all the rest of these are at best showing bear tags in energy and healthcare, but at worst still kind of looking like the Dow Jones. We're just getting up to it and not quite getting through it, that falling moving average. And above, and getting close to 50 on the intermediate line, but not quite above it yet. All right, that brings us to our trade idea of the day. I want to take a look at Costco. Costco has been on a nice little bullish move itself. Had a pretty decent response to its earnings announcement, keeping us from turning back down and staying bullish. Dark green shading in a green line. The intermediate line's rising above its market sentiment. The near-term line's back up above. In fact, they're all three lines are almost to that 80th percentile there. So a good bullish pattern from that perspective. Obviously, you also have three green arrows again. You never did have the three reds, so you've just been kind of in convergence mode, but you're back to three greens today. So that's a good development there. You can see where all the moving averages are rising, all in the right order. You're above the value area, well above the 200-day moving average. So very positive, very bullish pattern from that perspective. You don't have a mature trend, but you have an intermediate strength trend going here up above 2, above 65 down there at the bottom, above the cloud. It's still green, positive rate of change. The RSI and the CCI are up bullish levels as well, above, at least in the upper half of the chart, almost back above 60, above 100 there on the CCI. Looking at the DMI for Costco, you can see you got a bullish crossover. They're still pretty low, so it's not the most bullish pattern there yet. And the Bollinger Bands also kind of show the same thing. You're in the upper half of the chart. You're not quite outside of the bands. And the bands are still way inside of the Keltner channels, which sets you up for a move to get outside of the bands. We don't quite have that. So I'm bullish on this, but not too aggressively bullish. So what we decided to do is do a bull put spread, selling this 560, buying the 555. It sets you up for this pattern, full position size, pretty good return on risk. We think we ended up getting $1.20, which is what we need to get to on there. You can see the break evens on Costco. If you look at on the intraday chart, especially because it's a short vertical, you can see we'd have to drop back into the lower half of the chart for this to be start to lose what I'm willing to lose on this. I'm willing to lose trying to make 360, so we're willing to lose 360. So we'd have to really drop down there, considering how bullish we are. You'd also be, again, below that 559 level. If you take a look at like this chart here, you'd have to start breaking below like the 30-day moving average and get below this volume node. It's a pretty decent support here. So again, like if we get down into this area, we're not going to want to be in a bullish trade anymore. So I like how the setup here is for our risk management as well as where our stop order ends up being. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.